When we think about the massive biopharma gold rush, we usually picture the giant pharmaceutical names slapping their glossy logos on the next blockbuster drug. But behind the scenes, there is a $48 billion Swiss giant doing the absolute heavy lifting. That company is Lonza Group, and they are essentially the invisible engine powering the modern pharmaceutical industry. Welcome to this explainer. Today, we're going to completely break down their business, untangle their surprisingly complex recent financials, and figure out exactly what is driving their massive valuation right now.
Okay, let's dive right into this and lay out our roadmap for today. We're going to start with the biopharma infrastructure, unpack a rather huge financial paradox, look at their major growth engines, weigh the bull versus bear case, and then finally wrap it all up with a final investment verdict.
All right, starting us off with Section 1, the biopharma infrastructure.
So to really understand Lonza, you first have to understand just how notoriously volatile the biotech sector is. Usually, investing here means you're placing a massive bet on clinical trials, crossing your fingers for FDA approvals, and just hoping a single drug becomes a massive commercial hit. It's incredibly risky. It's kind of like betting everything on a single horse. Which brings us to this powerful question. What if you could invest in the pharmaceutical industry without trying to predict which drug will become the next blockbuster? That right there perfectly encapsulates the Lonza model. They don't try to discover the cures themselves, they provide the essential tools, the facilities, and the expertise to the companies that do. By doing it this way, they spread their exposure across the entire industry rather than risking it all on one unproven therapy.
The technical industry term for this setup is a CDMO, which stands for Contract Development and Manufacturing Organization. Basically, think of them as the absolute indispensable factory floor of the biopharma world. Look, when a biotech company actually manages to develop a breakthrough therapy in a lab, they usually don't have the billion-dollar, highly regulated facilities sitting around required to scale it up, manufacture clinical batches safely, or produce commercial medicines for the whole globe. So Lonza steps in. They are the ones selling the metaphorical picks and shovels to the gold miners.
And their core ecosystem is just massively broad. We're talking everything from complex biologics and your traditional small molecules all the way to cutting-edge cell and gene therapies. Lonza literally touches almost every corner of pharmaceutical development. But what's really compelling for us watching this right now is that Lonza has recently been shedding unrelated healthcare businesses, like their capsules and health ingredients division, to become a pure-play CDMO. They're streamlining their entire identity, which honestly makes tracking their core operational performance so much easier.
Moving right along to Section 2, unpacking the financial paradox.
Now, what's really interesting here is the sheer disconnect between illusion and reality. If you just took a quick glance at Lonza's recent trailing 12-month financials, you might actually think the company was in serious trouble. Their reported trailing 12-month net income sits at a negative $136 million. Yikes, right? But wait, compare that to the reality of their operating performance in the first half of 2026. They generated over 1.1 billion Swiss francs in Core EBITDA, and they're growing at over 27%. So how on earth is that possible? Well, as investors, we always have to distinguish between a reported accounting profit, which can get completely dragged down by divestments, one-time charges, or just accounting technicalities, and the actual underlying operating reality of the business. To cut through all that noise and confusion around the net income figure, we have to look at the actual cash being generated. The reality is, earnings can be highly manipulated by accounting rules. Free cash flow, on the other hand, that is way harder to fake. It tells us exactly what cash is actually entering the business's bank accounts after they've paid for all their necessary capital expenditures.
And this right here is where Lonza truly shines. In just the first half of 2026, they generated 0.4 billion Swiss francs in free cash flow. Just to put that into perspective, that is a massive improvement of roughly 0.3 billion compared to the previous year. When you have a company where earnings are increasing, margins are expanding, and free cash flow is surging upward, you have a tremendously powerful combination. It totally grounds our analysis in absolute reality, completely overriding that negative net income illusion we just talked about.
We can also see this financial strength reflected directly in their dividend history. Looking at the OTC dividend payouts, there's a serious jump from roughly 30 cents in 2025 to almost 40 cents in 2026. That is a nearly 33% increase. But a quick word of warning here. With an incredibly low yield of around 0.57%, you absolutely do not buy Lonza for the dividend income. The dividend is simply a signal of their overall financial health. You buy Lonza for the biopharma growth, the expanding margins, and that surging cash flow.
Let's move to Section 3 and see how this all builds, the major growth engines.
We know the cash flow is great, but where exactly is it all coming from? And this brilliantly illustrates the answer.
While overall sales grew at a very healthy 16% in constant currency, just look at the specialized divisions. Specialized modalities grew by 22.6%, and advanced synthesis absolutely exploded with 27.7% growth, boasting incredible profitability. This just proves that as drugs become vastly more complex to manufacture, Lonza's highly specialized services become exponentially more valuable to the market.
Now, a huge chunk of this specialized growth is coming from ADCs, or antibody-drug conjugates. If you follow the space, you know these are incredibly exciting, highly targeted therapies in modern oncology. Lonza is aggressively expanding its commercial-scale aseptic capacity for these ADCs in Switzerland. But here is the absolutely critical detail. They aren't just building speculative capacity and crossing their fingers the customers show up. No, this expansion is fully backed by long-term customer commitments. It's guaranteed demand, which massively de-risks the heavy capital expenditure they're putting into it.
Which brings us to Section 4, the bull versus bear case. Look, the underlying business is clearly firing on all cylinders right now, but no stock is without risk. It's a delicate balancing act. The bull case is fantastic, right? We've got rising trends in biopharma outsourcing, surging demand for complex biologics and ADCs, which all leads to higher utilization, expanding margins, and rapidly growing earnings. But we have to be objective. The bear case is equally grounded in reality. Biotech funding goes through boom and bust cycles. If pharma spending slows down, manufacturing demand falls right along with it. Plus, Lonza themselves have actually warned of a slower second half of 2026, mainly because the first half benefited from some very favorable project timing.
When we rapidly break down the specific risks, the very first thing that jumps out is the valuation. A forward price-to-earnings ratio of 28 is pretty demanding. It means the market is already pricing in a ton of future earnings growth. Add in the risks of biotech funding potentially drying up, unpredictable foreign exchange headwinds, and the heavy capital expenditure required to build all these new facilities, and you quickly realize that expectations are literally sky high. You absolutely cannot just annualize that 27% first-half growth and assume it's going to last forever.
So, the crucial point here is this classic Wall Street lesson. Good results do absolutely not mean the stock automatically goes up. In fact, after Lonza posted those excellent July results, shares actually dropped around 4%. Why? Well, because investors were spooked by management's warning of that slower second half, and they simply decided to take profits. When a stock is priced for perfection, even the slightest hint of moderation can trigger a sell-off.
All right, let's bring this all together in Section 5, Final Investment Verdict.
The real anchor for our verdict is their 2026 full-year guidance. Management has maintained their expectation of 11 to 12% sales growth. But check out that margin expectation. They actually upgraded their core EBITDA margin to 33 to 34%, up from their previous somewhat vague guidance of simply above 32%. This is management putting a massive flag in the ground, signaling to everyone that despite a slower second half, overall profitability is going to be even better than they originally told the market.
Based on all of that, here's a clear, objective strategy playbook for this medium to high-risk stock. Step 1. This looks like a buy on pullbacks, but only if that 11 to 12% sales guidance remains strictly intact. Step 2. It's a really solid hold for current investors, as long as margins and free cash flow keep tracking upwards. Step 3. Closely watch the second half of 2026. We want to see if growth normalizes smoothly without totally crashing. And finally, Step 4, this becomes a definite sell if management is ever forced to cut that guidance or if the free cash flow suddenly goes into reverse. Honestly, at a 28x multiple, you do not want to stick around if the fundamentals start slipping.
Ultimately, the entire thesis comes down to this core philosophy. Lonza isn't trying to discover the next blockbuster drug. It's trying to become the company that pharmaceutical companies can't live without. By transitioning into a pure-play CDMO, expanding heavily into high-margin advanced synthesis, and locking in those massive long-term contracts, they're making themselves structurally indispensable to the future of global medicine.
Which leaves us with one final thought to ponder today. Given their incredible underlying cash flow, but paired with a valuation that essentially demands near perfection from here on out, is investing in this picks and shovels infrastructure truly the safest way to play the biopharma boom? Or are expectations simply way too high to buy in at these levels? Keep a very close eye on those quarterly margins, wait patiently for your pitch on a pullback, and thank you so much for joining us on this explainer.